start by talking a quick introduction, Ryan, to you and the work that you do.
Yeah, so we're early stage fintech investors. So try to be, kind of that first check into new companies that are forming to try to change financial services. We have a pretty heavy focus on the U.S. market, so the vast majority of our portfolio is here. And what we try to do is, after we invest, kind of systematically connect our founders to the broader financial services ecosystem. And we really think of that as having five kind of constituent parts. So there are potential partners. Pretty much anyone who's touching money is going to need to work with somebody else. And so we help to kind of facilitate those connections. Regulators and policymakers, to the extent that a company is doing something in a regulated space, the seed stage is one of the most productive opportunities to start those conversations. Media and digital influencers. For the most part, these products are being sold on the internet, and so that the more they can tell their story, the better off they're going to be. And then other investors. We really want to help our companies get kind of the next stage of their growth, and that involves raising more money, and so we want to help them build those relationships. And then finally, other founders. The hardest part about building a business is most of the small stuff and kind of the mental game, and having other founders who are at kind of a similar stage can be really productive for a company.
I definitely see that. And I love speaking to investors in the space. Your perspective and where you sit sort of in the value chain is a big compliment, I guess, to a lot of the operators, I think, that we have at our conferences. What's your path? Like, how did you get here? How did you start investing? And tell us a little bit about your journey.
Yeah, it's pretty random. I think it's kind of it's one of these things. I think there are some people who kind of set out like, I'm going to be a VC, and then other people who kind of find that path a little bit. So I actually started my career in emerging markets and did a lot of work abroad, and worked in about 50 different countries, from 2007 till 2013 or so. And at some point it was just a lot of travel, and I got a different job, and I worked for a bank here in the U.S. And I had always assumed that the banking system in the United States was better than it was in a country like Pakistan or Egypt. And while it is, it's still pretty bad. And there are just incredible opportunities for it to be improved. And so I found a role working for a nonprofit, it's called Financial Health Network now, that had received a large grant from JPMorgan Chase to try to support new innovations in consumer financial services. And through that started investing, really saw firsthand, how many innovative entrepreneurs were working in this space. Saw that the returns of these early investments were really phenomenal, and left that in early 2018 with my partner, who was an operator, had sold a business before, to start the Financial Venture Studio, and really trying to kind of be that first check into companies, and then really help them to kind of that next stage of their growth.
So let's talk about FVS, and is it fair to call it that?
Yeah, that's great.
Okay, great. And what kind of companies you invest in, sort of the mandate? Let's talk about that.
We're looking for things that are growing fast. It's kind of the broad mandate, we want to see fast growth. But, that involves, a lot of consumer. We're probably one of the more active consumer fintech investors in the country. Products that have a similar demographic base as consumer fintech. So an actual individual signing up for it. So that could be a small business, could be a small enterprise, realistically, if someone's trying to sell something to the Financial Venture Studio, they'd probably be talking to me or my partner. And my decision-making is probably a lot more similar to a consumer than, say, if I'm trying to sell a new core to Wells Fargo. That's obviously a very different sales process. And we like self-serve enterprise tech businesses. We do a lot in payments. That continues to be a really active growth area, and an area where there's just so many different hooks into the financial transaction, to the value chain. That's kind of evergreen area of activity. We're doing more on the embedded fintech piece of it, so helping fintech companies grow more quickly and eliminate kind of the redundant development process. But I'd say, by and large, we see, to the title of the session, we see really significant opportunities in a lot of the neobanks, challenger banks, whatever you want to call this category. It's been a very active area for us, and we continue to invest very actively there.
I guess as an investor is getting in early, obviously the amount of money coming in later stage rounds and size of these investments is and step ups in valuation is pretty impressive. Like, do you think that continues? Do you think? I mean, we had Renaud Laplanche on here, the CEO and co-founder of Upgrade, and that was, I think he was a unicorn within 2 years. Cycle times are incredible. What do you think? Sort of, how does this sort of play out over time?
I don't think it's changing. I think what's happening, it's one of those things. I think when you're in the financial services industry, it's hard to fathom how large of a market this is. I mean, this represents about 20% of global GDP. It's kind of a similar stage of like the United States' GDP. It's a vast market of many trillions of dollars, and there are so many areas where it can be improved, and there are so many kind of ossified incumbents littering that landscape that there's really unlimited opportunity. And when we think, I mean, that kind of step of evaluation and that kind of the capital requirements that are, frankly, I think in fintech, capital requirements are often driving those steps of evaluation. So in some cases, you get a company that's just, people are just chasing after it because it's growing so fast. In financial services, you really can't, like if someone want to create a de novo credit card product, they're going to have to raise a couple $2 billion to even realistically compete with the big players out there. Mm-hmm. And I think anyone would kind of recognize that. And so it's going to lead to really dramatic step ups in valuation pretty early in the company's life cycle, once they can prove some of those early kind of proof points. Is there some demand for the product? Can you build a team? Do you have like the partnerships in place to help the scale? And so that's where we spend a lot of our time, under the understanding and frankly hope that we can get the companies far enough along that very quickly they're raising, $100 million plus financing rounds to support their growth. And so that time frame of going from kind of seed to unicorn status in 2 years, I think we've had one of those companies for the last 3 years in the portfolio. So it's certainly the model we're going for.
Totally. And I've had some conversations with our reporters at Tearsheet and who are sort of new to the industry. And I was saying like $100 million, private rounds, like that was the size of IPOs a few years ago. We never had 9-figure rounds. But it's happening regularly now in the space. What other trends do you see sort of playing out now and into the near future?
Yeah, I mean, the biggest trend is everyone's now a consumer of fintech products. Right. I mean, it's hard to understate how big of a trend that is. I used to joke around, there was, the CEO of one of these big kind of fintech enablement, products where, if you were building a fintech company, you kind of had to use this founder's product to kind of get access to the underlying data and help kind of enable what we were doing. And 3 years ago, I said, "Hey, what do you think? There's probably like 15 million like active customers in fintech." And he's like, "That's probably maybe a little bit more than that, but probably about right. Like across the entire US, there's 15 million people who are comfortable uploading their information and downloading an app and using it." I think that number is right now probably more like 150 million. I mean, you saw it. There's such a dramatic growth of the user base during the pandemic, which literally nobody saw when the pandemic started. Like, it wasn't like this is a predictable thing and everyone's genius. Like, it was completely unpredicted. And that's just phenomenal. It's case of kind of rising tide lifting all boats. And, those companies that were really strong have done phenomenally well. But even companies that, were still kind of looking for their footing, I think have benefited from just a wave of new users and more activity. And, frankly, that's never getting undone.
Can you talk maybe about some companies in the portfolio where that you see that to be true?
Yeah, I mean, so one area where we see it, and going kind of to the question around challenger banks, and I'd say it's kind of category we're looking at of kind of curated fintech, where consumers are increasingly going out and finding a product that fits their needs. That whole category, I think the landscape for it has shifted. So a good example is a company called Daylight, which is a really early stage company portfolio. It's helping. It was essentially a neobank targeted at the LGBTQ plus community.
Speaking at this conference too, day 3.
What's that?
And they're speaking at this conference too, day 3.
Oh, look at that! There you go, overlap. Like that, coming from both sides. Yes, I mean, Daylight. that product would have been really hard to launch. And let's just forget about they're targeting a very historically discriminated against, still discriminated against group of people. Let's just assume there isn't any discrimination. You're going to launch a bank that's going to target, the queer community 5 years ago. Outside of, a major urban center, like you'd have a tough time finding enough users for that. Now that community represents tens of millions of Americans who are primary community, and then probably other tens of millions who align with it and you like it, or just like elements of the product. And so as you've had more people become comfortable using these fintech tools, a product like that might seem to an outsider to be a somewhat niche product becomes a really viable product when they can roll it out across the entire country. And I think what makes that company so compelling is, yes, that's that's an interesting hook on the acquisition strategy, but that community is also incredibly diverse in what they're looking for. Mm-hmm. And so when we looked at that, when we met that company the first time, you're kind of struck by, I think, the primary feature at the time was essentially the ability to kind of pick your name. And so, like, if I was a transgender person and I was born with one name and I chose to go by a different one, or I actually do go by a different name for my legal name, I go by middle name. Mm-hmm. That's really hard to get the card to change that, and that seems like a small thing. But if I can do that effectively, what that means is I can create a different banking experience for everybody who uses my product. So if the name is going to be different, well, maybe the envelope is going to be different. If I live in a community where there aren't a lot of other LGBT people around, I might not want a bright yellow card. I might not want a bunch of flamboyant packaging. So they have to have a different servicing experience for me than if I live in West Hollywood. I'm totally comfortable with that. And so you end up with a very individualized banking experience, I think transcends just that community at scale and allows them to create a really, a customized, curated banking experience for consumers.
Yeah, so I really personally also really dig this these nuanced challenger banks that are servicing specific demographics and we have a few of them presenting here at the conference. If consumers are looking for more individualized banking experience, did I lose you? Oh, no,
clear.
Yeah. Sorry. How are banks adapting to that? Are they adapting to that?
Poorly.
Yeah.
For the most part, they are. Yeah. I mean, I think that there are a very small number of banks who are actively, trying to enable this trend, and are becoming incredibly important pieces of the financial services infrastructure. Many of them are smaller banks. They take advantage of that. It sounds like there's some much regulators on the call, but there's obviously. There's a Durbin Amendment to Dodd-Frank that creates essentially a different economic system for debit cards and credit interchange for banks below a certain size versus other ones. Those banks are doing kind of remarkably well at just enabling this process. The banks that
you have some gardeners outside or something.
I got a guy who literally just showed up just now to
of course, just now,
right outside the window there. And so that bank is doing kind of those banks are doing remarkably well. I think as far as many of the large banks, for the most part, kind of don't want these customers in the first place. Many of the largest banks in the country are kind of at their cap of the 10% deposit cap that they can support, and so there isn't a lot of reason to innovate around consumer and small business.
Great, Ryan. I have a question around Gen Z. Like, we've seen a lot of fintechs popping up to service that population with their specific needs and desires and wants. What kind of impact are they having on the industry? And could you use maybe a company in the portfolio to sort of demonstrate that?
Yeah. So we see this with a great example is. Well, I think at the high level, they're demanding a much more seamless digital experience. They have very little tolerance, I think, for kind of the clunkiness of, the idea of going into a bank and spending an hour and a half filling out loan applications and paper, I think is somewhat, just kind of revolting to a lot of those people. I think from a bigger perspective, their expectations for the consumer experience of a web of just like what the digital world looks like is quite a bit higher than I think any bank is really capable of providing. And then the other issue is, for the most part, Gen Z doesn't have any money, and banks like banking people with money. And so if there's there isn't a lot of reason to innovate to go target 23-year-olds. And I think that's ultimately one of the big traps that's faced, that the incumbent financial services industry is facing, is that near-term desire for profitability. And I think of less interest in really building significant consumer brands is limiting how much they're investing in early stage fintech companies, in early stage kind of opportunities there. We see this thing, a company called Point in a Portfolio, which is trying to create kind of a customized, Gen Z driven banking experience. So their view is like, we're going to be the Amex Platinum for, Gen Z, because very few people want to spend $600 for a credit card. But even fewer in the mid-20s demographic see a lot of value in doing that, especially when those rewards are really focused on somebody who's in their 40s or 50s and travels a lot. And so where Point is doing is trying to develops a really customized reward product. So if I spend a lot of money on DoorDash, I'm going to be rewarded on DoorDash. If I spend a lot of money going to the local salad place and Glossier, and you name it, I'm going to get a rewards package that incentivizes and rewards that kind of spend. And it still has a beautiful card experience, a beautiful digital experience, a lot of functionality that gives you privacy and controls. And that business has just grown phenomenally quickly. And I think if you think about what the ramifications are, this is just consumer banking 101, where you're getting consumers at a really early stage. You're helping them build wallet share, and you're building wallet share at them. And then as they get richer, there are more products to sell. And he said, when we tell people this about Point, especially bankers, are like, whatever, that's exactly what we have right now. It's like, no, you don't. You don't have that. It's not the same thing.
Interesting. It also requires sort of a patience to kind of start with a new product and then have them grow. It sounds like spending is a way in for a lot of fintechs to be able to service the Gen Z population.
Yeah, I mean, that's why I see a lot of payments. The payments piece would be pretty important.
So what else are you seeing, I guess, from the fintech market addressing Gen Z? Because banking is just one thing. Do you have other companies in the portfolio that approach it through, I don't know, investing or insurance or something sort of ancillary?
Yeah. So I think we have a couple of others. We have a very recent investment in the portfolio in a company called Addition, which is very early, and they're helping consumers. They're helping businesses that have a lot of employees that make stock-based compensation, and the employees of those companies understand what their stock-based compensation package is and what the ramifications are to them. Obviously, most people who work in companies that have a lot of stock-based compensation are startup employees, which tend to be pretty young. They also, not all of them become wildly wealthy, but they're generally, and these are considered to be good jobs, and they're probably going to have relatively high paying salaries for a significant portion of their career. And so what Addition Wealth is doing is really using that as an opportunity to go and educate the employee on how to make better decisions with that money, how to exercise that stock-based compensation in a way that's going to be tax advantageous, and is going to frankly going to exercise. There's so many stories of people who worked at an early stage company and stuck around for a year and a half, maybe had some shares, and they just I didn't have the money to come up to vest it, and they just walked away from it. And 5 years later, it's a unicorn that's worth tons of money, and they kick themselves. And helping people understand that process is really important. And I think if you think about where wealth management is going, that a lot of those people are going to be people who are going to have a lot of wealth. And it's unlikely that after they've made decisions for themselves for 10 or 15 years, that they're going to hand the reins over to a bulge bracket investment bank to let them take over and pay them 1% a year. And so I think you continue to see that same trend where you see startups going into parts of the market that are seemingly low margin. The wealth management for someone who might have $100,000 isn't the thing. But as those people age and grow, they are going to have more wealth, and that's an interesting hook to kind of take away broad swaths of the revenue centers of
totally
financial institutions.
Ryan, you used a term earlier in our conversation, something called curated fintech or curated banking. Can you describe? I don't know what that is. Can you describe that?
Yeah, I think it's the idea that consumers are increasingly looking to kind of curate their own experience, and they're looking to create a banking experience, and in many cases a design aesthetic in their banking and their financial life that is very individualized. And I think we're seeing that trend comes across within many of these companies and how they approach design, how they think about product innovation, how quickly they're moving. It also is one reason we feel comfortable making so many bets in the category, because we look at this as as like a balloon where you make little pinpricks on it, you fill the balloon up with air. They don't get closer, they just get bigger and they move further away. And that market's expanding, and I think creating a lot of these little seeming little niches can become kind of vast markets as they grow. A good example was with Dave, which was an early investment of ours. It helps consumers avoid overdraft fees. I think a lot of bankers were like, okay, cool, whatever, just like keep money in the account, don't get an overdraft. But right. Most people can't keep money in the account to avoid an overdraft. About 150 million Americans can. And if you have an overdraft, you likely get about 7 overdrafts a year. It's the main profit center for many financial institutions in this country. And what Dave did is their message was really simple. Overdraft fees suck. Don't pay overdraft fees. Product's really simple. Scans your account, save your overdraft, and you can either choose not to spend, or you can get a small advance on average at $35, which would help you avoid the overdraft fee. People love the product. It grew phenomenally quickly and is now rolling out a bunch of other products around kind of that seamless banking experience. And I think if you're somebody who's really has overdrafts as a pain point, that was a great product for you and is a great product for you. Similarly, if you're, a member of the LGBTQ community and you really want to kind of identify as such or support it, like Daylight's a great product. If you're a 27-year-old who makes $100,000 a year living in Midtown Manhattan and wants like a fancy card, but doesn't want to pay for a Chase Sapphire card, Point is a great experience. And each of those people has a completely different set of interests and goals and kind of ambitions for themselves and their money, and are curating an experience that, at face value can say, okay, well, we do that. But there's a lot more to that experience than simply, the checking account or the debit card.
Totally agree. Ryan, it's been great talking to you. I really appreciate our conversation. Thanks for joining us on the Big Bank Theory Conference.
Yeah, thanks for having me. Appreciate it. And sorry about my.
Oh, no worries. Things happen. Dogs bark. Gardeners show. Really appreciate it. Great talk. So thank you.
Awesome. Thanks.